Welcome to Pekin Hardy Strauss Wealth Management's latest episode of Managing Your Money. Today, we are going to talk about gold. In our most recent quarterly letter to investors, we wrote a letter which is posted on our website, and I'm sure we can post in the notes of this conversation, understanding the forces behind gold's historic surge. So we're going to talk about what's been going on with gold this year, what our forecast is for the future, and what this means for other commodities, for other asset classes, and anything else that comes up related to this subject of gold. I'm going to start by just sharing my screen here. This is the performance of gold through December 1st of this year, 61.2%. And that 61.2% was not coming back from a terrible year. Actually, last year in 2024, gold was up 27.2%, beating the S&P 500 index. The year before, it was up 13.1%. Gold has had a historic run, not just this year, but over the last 3 years. And it's been the best performance of gold, of the price of gold, since 1979. I guess the question is, why do we think gold has had such a historically good year this year?
I would say, first of all, gold is priced in dollars, and the U.S. dollar. One driver is the fact that the dollar is down relative to a basket of currencies to the tune of about 10%. And if you look at how gold did versus a variety of currencies, it depends on the currency. Generally, it did a little better in dollars than it did the rest of those currencies. That is one aspect of many. There are other factors that are more specific to gold. Foreign central banks to continue to buy gold. The United States government, United States economy is becoming far more isolationist. And so you're seeing a lot more chinks in the armor of the dollar as a reserve currency. Still the reserve currency, likely will remain that for a long time. But there are transactions that are happening now between, for example, Brazil and China, where they're settling up the differential with gold. So it's becoming more useful as a reserve asset. And you're seeing more of that happening. And our debt levels continue to climb, both here in the US, Europe, Japan, everywhere. And so investors are looking at gold as much more of a strategic asset than they did in the past. You had a 40-year bull market in bonds starting in 1980 with rates going down all the way to 2020. And now it's hard to get excited about fixed income, given the fact that pressure on bonds, despite the rate cut today, is likely to be higher for longer. So it's a whole slew of issues, all that remain in place, in my opinion, in the years ahead.
What you said makes a lot of sense. You've articulated why we have been bullish gold for years, why we continue to be bullish gold. But I'm wondering, one of the things that I'm wondering, and I think it's fine for us to reiterate our gold thesis. It's important for our clients and others to understand why we like gold. But the question that's really bothering me is, why 60%? Why this year? Everything that you just said would have been a great explanation for why gold would have been up 20%. And yet it's up 60%. And so I'm wondering if there is, and maybe there's not, maybe this is just what happens, but I'm wondering if there's anything special about what's going on this year that makes this year different from all other years. So you don't have to answer that question. You can just explain why you think gold is going up, but that is a question I'm wondering about.
I think Liberation Day does play a role in all of the Trump tariffs, goods from across the world. Has helped to put a larger wall between the United States and other economies in different ways, which I think it's one reason why gold will be so much stronger this year. But in terms of other specific things, that's an excellent question. I don't know. What is so different about 2025 than other years?
I have a theory on it. And so I think that the main drivers have been fundamental, but I think that as with almost all trades nowadays, because of social media and levered products and things like that, I feel like every move that kind of gets some traction gets overdone to an extent nowadays. Whether it's the AI trade, whether it's gold or meme stocks or whatever they are. And I'm a believer in the fundamentals of the gold trade, but I feel like maybe a little bit of this trade or this move this year has been due to you get lots and lots of people glomming onto a popular trade. Even though it makes sense from a fundamental standpoint, maybe some of the move has just been because, hey, people found out or people heard, hey, gold's moving, gold's working, and everybody kind of crowds into the trades that are working. That's one of my theories for why the move has just been so pronounced this year.
I'm trying to find this chart, which is why I've been silent, and maybe I'll find it before the call is over. I would say a couple of things. First, you have Japanese long bond yields that are breaking higher. And gold historically, particularly recently, tracks the rise in Japanese long bond yields. And that's the chart I'm looking for, and I can't find it right now. So hopefully I can find it and show it to you. But it's almost a 1-for-1 correlation. And because inflation's getting worse in Japan, this new government came in, the fiscal stimulus is being spent, and Japanese rates are rising. So in one part, you can say that what is different this year is we haven't seen Japanese rates rise in probably 30 years. This is like an earthquake in financial terms. So I guess to answer part of your question is you have the pull of Japanese rates pulling gold higher.
How does that work? I don't understand the mechanism.
I don't exactly understand the entire correlation as to why gold is going higher with Japanese rates, but I know that the correlation's been almost a perfect fit. I'm assuming that it's a gauge of inflation, and so therefore gold is trading to some degree on inflation worries, although gold has changed its stripes all the time, whether it's an inflation hedge or not an inflation hedge, or currency hedge or not a currency hedge. But I don't know the exact reason for why it tends to correlate with Japanese long rates or why it has been recently. I will say that gold is like a chameleon. It changes its stripes every once in a while, and so this correlation might not hold going forward, but it certainly has been holding recently. And then I'll share my screen and show you where I really wanted to start as to not what broke down this year, but what major correlation changed a couple years ago to change it looks like we've lost Josh on camera at least, but let me just share my screen and I'll show you what major correlation changed a couple years ago. Hold on here. So this is, let's see if you can see my screen. So can you see my screen? Mm-hmm. Make this a little bigger. So this is from Dan Oliver and Mermaid Capital, and we all love him. And basically this, going to your point, Adam, this is a correlation break, right? So historically, we all know that this chart goes back to 2000, so about 25 years or so. Gold used to follow the 10-year, the kind of the real treasury yield or the inflation adjusted long-term treasury yield, which kind of makes sense, right? As yields went higher or as there was more competition for gold, then gold went lower, because if you can park your money in a CD or a treasury bond earning you 4 or 5% risk-free or essentially risk-free, that competes with gold. And obviously as yields drop and that competition decreases and you can't get money on your CD or bank account or a treasury bond, then the attraction of gold rises. And you see this kind of perfect correlation with gold in blue here and treasury, the real yield in black, and which is inverted, sorry. So basically, as the real yield gets lower or in this inverted scale, or as treasury yields fall relative to inflation, then gold rises. And you see this kind of perfect correlation until the Ukraine war in 2022, and this correlation totally breaks. Now, maybe this will happen with Japanese bond yields too. You can have a break in correlations. But at least to go a little bit backwards, I think to answer your question about today is you have to understand what has been driving this gold bull market, because you're right, gold is up 60% this year. It was up 28% or so last year, and it was up a lot certainly in 2022 and in 2020. But I think this is the most important correlation break, because basically gold started trading apart from real yields for the first time in 25 years. And
yeah, I think it's real. Like that, something for sure did change in 2022. Can I share my screen now, or do you have more?
No, go ahead.
Yeah, I'm just more about this correlation break in 2022. Let me share this. Here we go. So this shows central bank buying of gold. And perhaps to explain the correlation break in Billy's chart, what you see here is from the beginning with the financial crisis, central banks started becoming a little bit suspicious of U.S. Treasuries as being reliable as a foreign reserve asset. So they started buying gold for the first time in many years in 2010. And it was very steady around 600 tons a year. And then in 2022, it jumped up to about 1,000 to 1,100 tons a year ever since 2022. Exactly when that correlation broke on Billy's chart is where central bank buying almost doubled. And by the way, this is just official numbers. Gold, one of the reasons that we are struggling to answer some of these questions is that the gold market is a very opaque market. And so it's very possible that this is just what is officially reported statistics, but it's very possible that there are countries that are buying gold for their foreign reserves and aren't reporting it. It could be way higher than that. And it may be that the amount of buying has gone way up beyond even what we would expect to be reported this year. That's my suspicion, is that it's central banks that have actually accelerated their gold buying this year for whatever reason. Maybe it's the tariffs, maybe it's something else. I'm not sure I buy Matt's thesis that it's individual investor speculation, because if you look at like the amount of money that's been going into the US gold ETFs, it hasn't really been a lot.
That's absolutely right. The gold ETFs, the shares outstanding have decreased, actually.
The gold price has gone up, and the United States investor has, for the most part, been left behind.
That's exactly right. And usually the Western investor comes in to the gold mining shares, or GDX, the major gold mining ETF, is usually how Western investors express their feeling about gold. And those shares have also been declining this year. So the Western investor has been completely absent. They've been, by and large, completely absent. Bank of America has said the average retail Western investor has 0.5% of his or her portfolio allocated to gold, and the average Western institutional investor has about 2%. Okay, here we go. That's that 2% allocated to gold. Sorry, Adam, go ahead.
Yeah, no, I just wanted to give a chart to support your point. This is a survey from the 2025 UBS Family Office Report that basically shows the average family office has about a 2% allocation to gold.
What does it look like? What does it look like in India and China and Europe and Japan? I hear you, because there's less of a social norm in the United States to own gold versus China and India, where it's been part of their portfolio forever. Or then you have the Turkish portfolio, which is half gold and half stocks or something, because they don't want to own bonds because of the inflation they have. So if you're looking at a global asset like gold, does it really make that much sense to look at it just on a U.S. perspective?
It would make sense to look at it in every way. I'm merely bringing this up to basically suggest that the U.S. investor, the Western investor, does not appear to be the force that drove a 60% return in the gold price this year. That's all. That's the only point I'm trying to make with this chart. And I guess one more thing I might say is, if and when the U.S. investor and the Western investor decides to go into gold in a significant way, watch out. It hasn't happened yet. Like, the gold price is up 60% without that happening. So what happens when it does happen? But so I think so far, I think the explanation probably lies somewhere in Asia. Maybe it's a combination of central bank buying and investor buying. Maybe it's mostly central banks. Again, the market is very opaque. It's hard to know, but it certainly feels like it's coming from the East.
Yeah, and if you look at the price of gold, I don't know, Adam, you started with the price of gold in dollars, but the price of gold has been breaking out in Japanese yen and Indian rupees. All over, it's been breaking out. This is not just in Chinese yuan, this is not just a dollar-based rally in gold. It's really certainly very much an Asian-based, could be certainly arguably global-based, but very much centered in Asia. So I think that answers your question. I think that the biggest break, as I showed you, was that correlation change in 2022 where gold stopped tracking real rates. The question is why? And I think the answer is that when the U.S. seized the foreign reserves of Russia, which is the first time that's happened to a G20 country, that was a wake-up call for lots of developed nations and for nations that are only modestly aligned with the U.S. or not aligned with the U.S. to say, oh my gosh, I used to have my reserve assets in mostly treasury bonds, and now with what happened to Russia, they can be seized at any time if we do something or say something that the U.S. government disagrees with. And so I think that is why the correlation broke. That accelerated the chart that you showed, Adam, of all the central bank buying, official and unofficial. And again, it's not been mostly a Western investor. It's been a largely Asian central bank, but global central bank scramble to secure a neutral reserve asset, a reserve asset that is safe, that is nobody else's liability, and that can't be controlled by the U.S. government.
Yeah, Bill.
Okay, so let's we're not going to know for sure. Let's move on to the next question, which is somebody's buying the gold. Maybe it's central banks, maybe it's Asian investors, maybe it's a combination. Why are people buying gold in such an accelerated fashion? We know the general thesis. Josh presented it at the beginning of our hour. Is there something that's coming down that people are trying to get ahead of by buying all this gold in such an accelerated manner?
Well,
I go back to the Liberation Day theory. Over the last 10, 15 years, to take the Chinese as an example, the Chinese the populists have been aggressive at trying to get money out of China. Whether it's buying real estate in Vancouver and Toronto, as well as on the coasts in the United States, or buying NASDAQ or the S&P and things of that sort. I wonder to what extent Liberation Day was a bit of a wake-up call to the Chinese, to the wealthy Chinese, to say maybe we need to be looking at gold more. And the Chinese are among the most momentum-oriented investors out there, and momentum has certainly been good with gold, and so they're just jumping on. This is just a speculation on my part, but it rings true in my view.
I would go a step back, and this is a Louis Gove from Gove-Cowell idea. I'm going to steal his idea. He really said the changing point wasn't, or the wake-up call wasn't so much Liberation Day. It was Trump 1.0, his first term, when he did the original semiconductor ban in 2018 against China. That was the ultimate wake-up call that China had to be self-sufficient in everything, because it can never know what may happen in the future. And that is why when Liberation Day came, after all the work and all the industrialization and all the commodity sourcing that China did in preparation for an eventual possible Liberation Day, why China was able to stand up to the U.S. and why Liberation Day and these huge tariffs ultimately failed. Because China could fight back, because it had spent the prior 7 years getting self-sufficient and all this stuff. Part of that self-sufficiency, I think, was not buying treasuries in the way that it had been buying treasuries before. If all of a sudden China was put on notice that the U.S. may or may not be an ally, or may or may not sanction its access to certain critical markets or commodities, then what interest or what incentive does China have to support the U.S. government debts and deficits and buy the bonds of its maybe ally or maybe enemy? And I think that was the major change. And I think China has been, to Adam's point, either officially or unofficially putting its major reserve assets or foreign surpluses into gold rather than U.S. treasuries. We have today, to answer, sorry to take a step, we have today that China now this year, I think, has the first ever has achieved a $1 trillion capital surplus, which is, I think, never seen before by any country. If you have $1 trillion of excess capital, and those are no longer primarily going into treasuries, but they're going into something else, perhaps that's the other. We've never seen this. China wasn't enjoying those types of surpluses 8 years ago, 5 years ago. It is today, and that could be a lot of the buying power behind all the central bank buying in gold, which is why this year is different from other years.
And it makes particular sense to own gold rather than a U.S. dollar denominated asset, just given that I think a lot more trade is going to be conducted in non-dollar currencies, and with gold potentially as a settlement currency for some of this trade. So it makes a lot of sense for not just China, but other countries too, to have more gold as a potential trade settlement currency.
I think that's true. And I think also Adam's getting at what crisis is going on or what change is going on also to trigger an increased interest in central bank buying of gold. And the obvious thing that has gotten worse this year, much worse this year, although it's been a slow-moving train wreck for quite some time, is the fiscal situation of the U.S. and the West in general, right? So if you are China or Saudi Arabia or another country, another surplus, current account surplus nation, and you have a choice of where to invest those surpluses, it was a no-brainer 20, 15 years ago to invest in the U.S. It was the reserve currency. It was the most stable economy, the one hegemon, the military superpower. But today, as the U.S. fiscal situation looks worse and worse, we are now at $38.5 trillion of debt and climbing, soon to be $40 trillion by next year, running deficits of 6%, which is unheard of in peacetime. We are increasing our money supply by 8% a year. What would behoove China or other central banks to buy treasuries that are being devalued at 8% a year, or other Western reserve currencies that are also being devalued at high single digits per year, when they could put those resources in something else like commodities, like gold, that might actually inflate instead of be devalued? And to that, let me share my screen, because I thought this was such an eye-opener, and you guys have touched on this. Can you guys see this? I'll make it a little bigger. This is a stunning chart to me, and this came out a couple months ago, but this goes back. This is a 50-year, 55-year chart. Gold is in yellow and U.S. Treasuries is in blue, and this is foreign central banks' holdings of gold versus Treasuries. This is the first time, right? Adam's, what is different today? This is the first time since 1996 that central banks are holding more gold than U.S. Treasuries. And while this has been a trend that's been going on for a while, as gold has slowly climbed, or slowly then suddenly, and Treasuries have slowly declined, these two things cross today, and these trends are accelerating. So this is an eye-opening chart, right? Because for the first time ever, we are getting to a situation where central banks en masse are hoarding more gold than U.S. Treasuries. It questions it prompts the next question I think that Adam might ask is, okay, how high can gold go? And it's, while in our modern memory, and I say modern memory going back 25 or 30 years, we've only known a world basically where U.S. Treasuries were the preferred reserve asset, right? That's how we all grew up, and so we think that's the way the world should be and always was. But if you take a longer look into history, and this isn't even that long, but 50 years, if you go back even 100 years, you see that gold was always the dominant, historically at least, mostly the dominant reserve asset in central banks. And so we are today, gold is what, 25% of global central bank assets? It could easily double from here just to get back to where it was in the 1970s.
So, in other words, Billy, you're saying nothing stops this train.
Yes. Nothing stops this train.
I have another chart that supports what you were saying. That was the next question I was going to ask: is, are we at a place where we should be selling now? And I think that's an important question that we should always be asking ourselves. Well, with any asset class, but certainly after 60% run. This is a chart that I produced when we put out the letter, and it basically shows the value of the gold that the United States owns relative to the monetary base. And when the Federal Reserve was first created by law, the dollar was required to be backed by gold at the level of 40%. And if you look at the sort of history of gold relative to the U.S. monetary base, it has averaged around 40%, but with huge fluctuations above and below. And the last gold bull market, which ended in 1981, ended where the value of the gold that the United States owned was about 120% of the value of its monetary base. And no surprise, over the next 20 years, gold did nothing but go down. But right now, even after all of the rallying that has gone on with gold relative to the monetary base of the United States, we're still around 12%. It's very low. And the reason it hasn't grown with the price of gold is because the monetary base of the United States, all the debt that it's issuing, is growing every bit as quickly as gold is growing. And so whether you look at it in terms of the gold on the balance sheet of central banks, or the extent to which the gold that the United States is holding in Fort Knox and other places is able to back its monetary base, should that ever be needed, there's just a lot of signals that suggest that, there's a long way for gold to run from current levels.
So if this is right, if it was, I say that the average is about 40% in this chart historically. Was
that
the number you said? So that means gold would have to climb about 4 times, or could climb, if we get back to that average number.
3 to 4 times.
It would 3 to 4 times. And my understanding was that the Bank of England, when sterling was the reserve currency pre the Second World War, the Bank of England always held gold as at least 25% of its reserve. Maybe the U.S. standard, the Fed is 40%. For the Bank of England, for many years, it was 25 to 30%. At 12% today, we are certainly way below average of what most reserve central banks have as a percentage of their assets that are backed by gold, or their debt that's backed by gold.
Yeah, and that doesn't mean, that might mean that gold has the opportunity to double or triple or quadruple, but it could be way more than that. Because remember, while this is all going on, the monetary base is continuing to expand and will continue to expand at a very rapid, like a double-digit rate. I think there's a lot of reasons to be bullish.
I think that's a great point I was going to share. I have that exact same chart that I was going to share, but you already shared it. And then I was going to say, what's interesting is that if you look at the monetary base, I believe the monetary base has expanded by 8% since going back to 2000 at least, has expanded by 8% per year over the last 25 or so years, and gold has climbed about 10% per year. It does, again, going back to these correlations, it does tend to correlate with the expansion of the monetary base. Again, not one for one, it's a little bit more than the expansion of the monetary base. But if nothing stops this train, and we're in an era that the monetary base has to continue to expand because our debts are so big they cannot possibly be repaid, all we can do is keep rolling the debts. And as long as we keep running major deficits, the monetary base, by definition, has to expand. Whether it's an 8% clip a year or 9 or 10 or 7, what have you, that means there should be upward pressure on gold.
Yeah.
Sorry, at the expense of talking too long, I'll say one more thing. There's one more metric there's two more metrics that I'll start with one at least, then I'll be quiet for a little bit. When you talk about how high gold can go, I think the percentage of gold of Federal Reserve or central bank assets, whether that's that 25 or 30 or 40% is one metric to think about. Again, is the second metric was how much will the monetary base expand over time, and gold should go with that. And I think another historical benchmark to think about where gold can go from here is in the three big bull markets of gold in the US in this century, the 1930s, the 1970s, and the early 2000s. And each of those was roughly a 10-year period of time for a gold bull market, roughly. Gold went from trough to peak about 8 times. So the trough of this current cycle was 2015-16, where gold bottomed at roughly $1,000 an ounce. Today we are at roughly $4,200 an ounce. So if history holds, and this cycle is similar to the 70s and early 2000s and 1930s, gold could possibly go to $8,000 an ounce if it reaches that full 8 times.
And that's just assuming mean reversion, let alone the fact that it could go past the mean.
On the topic of mean reversion, I want to ask a question. There's historically been a fairly consistent relationship between the price of gold and the price of other commodities. And it seems to me that relative to a lot of other commodities, that relationship is breaking down or has broken down. I'm going to show you the gold oil ratio just as an example. So like this just shows a fairly steady ratio between the price of an ounce of gold and the price of a barrel of WTI oil, around 20 times or so. Ever since, 2015 or so, it's still going up and down quite a bit, but there's been a gradual trajectory up. And I'm picking on oil here, but if you look at the relationship between gold and just about any other commodity, you're going to see a similar sort of expansion in the ratio that began in 2015 and hasn't stopped. And so I guess my question is this going to revert to the mean, or are we moving to a new normal? And if it does revert to the mean, does it revert to the mean by gold going down or the commodity prices going up?
I guess I would say there's two things here. So one, I do think that a lot of other commodities, oil especially, are more likely to go up and help to catch that ratio back up. But I also think that given what we were discussing earlier about the momentous shifts in like central bank buying and eschewing of treasuries as a reserve asset, I do think that we are potentially in a paradigm shift with respect to gold. So I think the answer is both, Adam. I think that we are making like a step change in the value of gold because of that central bank appetite for gold. But I also do think that a lot of other commodities are underpriced, oil especially, and other energy-related commodities, which have really languished over the last couple of years. So I do think that we'll see those commodities repricing upward, but not necessarily going back to the historical mean ratio.
Okay.
I think, and I'll just say, you are beginning, there's the gold to oil ratio is unusual, right? We, except for 2000, that the flash crash of oil in 2020 and during the unusual COVID period, we've never seen a gold to oil ratio this high as shown in the chart. And I would argue that oil should get more historically, if historical correlations, go back to the question about whether correlations hold or not, if historical correlations hold, then it would augur for the price of oil to rise over time. So I believe that is coming. I don't know if that's a 2026 event or 27 or 28 event, but I think you have to believe usually when gold runs, oil runs with it. So I would, all else being equal, I would think this gold to oil ratio should come down over time, although anything is possible. And if gold continues its bullish march, it might stay elevated even if the price of oil rises. What you do have today is commodities breaking out all over the place, right? Everyone's attention has been focused on gold, but silver has outpaced gold this year, and copper is up dramatically this year, and platinum is up tremendously this year, and palladium is up tremendously this year, and aluminum is up. So all these commodities are breaking out of their long-term slumber. To get to your point, Adam, if gold is the first mover, then the whole commodity sector is waking up. And it looks like they are all rising in tandem, except for oil right now with gold.
And natural gas.
And natural gas, but it's a localized market. It's a little bit different. It's not a global market yet.
That's true. That's true.
One of the interesting developments that's happened either in conjunction with the stunning performance of gold this year, or perhaps as a result of it, is advisors are starting to recommend higher allocations to gold than what we've seen before. I'm going to go back to the chart that we briefly touched on before. Current allocations in family offices on average are around 2%. A couple of months ago, the chief investment officer of Morgan Stanley, Mike Wilson, recommended for the first time that their wealth clients own a 20% allocation to gold. Are we at the cusp of a trend of higher recommendations by financial advisors to own gold, higher allocations in general? And where do we think we're eventually going to get? And where should clients be?
I think the average financial advisor is going to be risk averse when it comes to allocating to gold. I'm not sure that they're going to put those kinds of large allocations because it's a transformation. The 60-40 allocation between stocks and bonds has been there for decades, and that allocation may be breaking down going forward. That is not a popular opinion. So I'm not sure that you're going to see you'll see investment advisors say, all right, we'll buy a little GDX, we'll buy a little GLD, maybe 1-2% of your portfolio in aggregate. In the short term, that's where I see it going. I don't see them making a bold call. Mike Wilson's call is bold, right? We have a large allocation of gold. We're well ahead of the rest of them, but for Morgan Stanley to do it, that really is bold. But I don't see the financial advisors at Morgan Stanley following him and following that recommendation for a variety of reasons. But maybe I'm wrong. I don't know. I just can't see there's too much entrenched view that the way to make money is to buy the Mag 7 and just buy and hold and see what happens. I just can't see that transformation.
It will take a lot to change. That mindset is deeply embedded in American investors' minds. It's very much an American and maybe a little more Western thing, but that is a deeply entrenched belief that you invest in the S&P 500, you forget about it, and you make a fortune. And the idea that you invest outside of the traditional stock and bond asset classes is really a foreign idea for a lot of American investors. I think that there are people that are waking up to it, such as Mike Wilson, but I think that it's going to take a little while before you get more of these sort of traditional investment managers recommending that sort of thing, because it has some career risk to it, right? Advisors they're going to be more prone to want to be wrong with the crowd than to step out on a limb and do something like having a significant allocation to gold.
I think it was a bold call for Mike Wilson to say that the 60-40 portfolio was dead. Others like Ray Dalio have said it as well. And there have been others that have said it. He wasn't the first, for sure. But when a major strategist of a major investment bank says that the 60-40 portfolio, or 60% stocks, 40% bonds, is over, and it really should be 60% stocks, 20% bonds, 20% gold, that is a sea change, as I think Josh commented on. My belief is that mood follows price. And that, to Matt's point, while it's hearsay for many people to suggest that gold allocation should be anything more than 2 or 5%, if gold continues to outperform in the way that it's performing, I think mood has already begun. Before, if you'd asked the average investor 5 years ago would they ever invest in gold, the answer would probably be no. Today, though, after a 60% move in gold this year and a 28% move last year, people's opinions about gold and its utility in the portfolio has changed. Two is the part of the reason why the 60-40 portfolio has died is because the 40 portion, or the bond portion, is not doing its job as being an anti-fragile asset. 10-year treasury bonds over the last 5 years are down like 30%. That is not a risk-averse asset anymore. And increasingly, treasury bonds are positively correlated with equities. That wasn't the case up until 2020. It was inversely correlated, which meant that it was the perfect defense to your equity offense. And when your equities fell apart, your bonds went up in value. But recently, we've been have seen equities and bonds act in tandem. And so if bonds aren't fulfilling their anti-fragile role, then it really only leaves gold, or maybe cash, as the only other anti-fragile asset. And so my other contention will be is, as bonds continue to wither as a portfolio hedge, portfolio managers and investors will look for something else to hedge their portfolio. That natural something else is gold.
Great answers. Thank you. I want to just touch on something that I hadn't thought of until just now, but I think it's worth discussing. Bitcoin has been discussed as digital gold. And yet, this year, gold's up more than 60%. Bitcoin, as we're talking, is probably around $91,000 a coin. It's about the same price as it was at the beginning of the year. I'd love to say it's gone nowhere, but it's been as volatile as Bitcoin always gets. It's gone up and it's gone down. But in the end, we're about at the same place as we were last year. And so I guess my question is, does our experience of 2025 put a hole in the thesis that was Bitcoin actually a form of digital gold, or is it really just a sort of speculative risk-on asset, or what is it?
I think theoretically, at least conceptually, that idea of being digital gold makes sense, but it isn't necessarily being treated that way, at least yet, by central banks. I think that's the big difference, right? Central banks are buying enormous quantities of gold. They're not buying enormous quantities of Bitcoin, at least to my knowledge.
Right.
So
right. Even the United States, which people thought was going to happen when Donald Trump became president, I don't think the United States is buying. There's been a couple of countries that have purchased Bitcoin, but most of them are insignificant countries that don't really matter.
Exactly.
The U.S. does own some Bitcoin. They didn't buy it. They got it in the FTX bankruptcy. And so they went bankrupt when Bitcoin was very low. And by the time things came around, all of the creditors got paid in full because the price of Bitcoin had risen so much. And so that was in the sovereign wealth fund that Trump wanted to make. There's a Bitcoin asset that's in there, and that's from the FTX bankruptcy.
So we haven't sold our Bitcoin, but we haven't bought any.
Yeah, that's right.
And importantly, neither has the Chinese central bank, or that's
the surplus. The countries that are generating very large surpluses are not buying Bitcoin.
And until they do, I don't see Bitcoin truly becoming that like digital gold asset.
I'll fade that. I'll be the first to say I don't understand what happened with Bitcoin this year. And if you had told me on January 1st of 2025, if you had a crystal ball and you said silver would be up 100% or greater, gold would be up 60%, and Bitcoin would be flat, I would have thought it was the major war, a major depression, the end of the world scenario, a liberation day that actually happened. I would have thought, oh my God, that must have been a really horrible. The S&P would have been down 20 or 30%. That would have signaled to me a really bad financial and economic scenario. And certainly that was not the case. This was a year where equity markets everywhere, most everywhere, are up in double digits, including the S&P, and even greater in foreign markets. And yet Bitcoin is the one anomaly. It almost looks like that gold to oil ratio chart that you showed. because it's unusual to have a year where gold is up so much and Bitcoin is not, just like it is with gold and oil. So again, either the correlations have broken down or Bitcoin is just consolidating like oil and is late and its move is yet to come. I would argue the latter. If you look over a 3-year period, Bitcoin is way outperformed gold. And going to talk portfolio manager speak, if you look at Bitcoin Sharpe ratio over a 3-year or any longer period, it's the best Sharpe ratio or the best risk-adjusted returns on the board of any asset out there. So I haven't given up the conclusion that Bitcoin is a form of digital gold. I believe it is. One of my explanations for what happened this year, and I've seen this thesis talked about, was this was a post-IPO phase for Bitcoin, where just as you have an IPO happens and a lot of the insiders and long-term holders are able to sell their shares and get liquid and diversify their portfolios, there were a lot of very long-term Bitcoin holders who liquidated billions and billions of dollars worth of Bitcoin this year. And maybe that is a sign that this is the top of Bitcoin, or maybe that is a sign that, like with many IPOs, that it's just another phase of Bitcoin. The IPO of Apple and Facebook and Amazon didn't mark the top. It was just a short-term top, and the tops were yet to come in all those assets in many IPOs, certainly not in every one. So I would argue that the top isn't in for Bitcoin yet, and that it's not just a levered tech asset, that it really is a form of hard money, of digital gold. And I would go back to Adam's original questions. I meant to bring this up of why now, and I think that we failed to mention what is going on in the overall monetary system. We hinted at the changes that China is making, but China also is setting up a alternative, or trying to set up an alternative financial system. We've talked about how they are not buying as much U.S. treasuries, and it's not only that China is replacing treasuries with gold in their reserve assets, but they are divorcing themselves from the SWIFT U.S.-American financial trading system and developing CHIPS, an alternative Chinese or Asian trading system where trade is happening in multiple currencies and net settled in gold. And what China is doing is trying to make the yuan a rival to the US dollar, and it's doing that by increasingly backing the yuan with gold. So some of the reason why there's this big increase in gold this year is China, with their very, very deep pockets, right, has decided to create a rival monetary asset backing the Chinese yuan with gold. The U.S., at least under this administration, seems to be taking the opposite stance, which is they're basically saying we are going to use stable coins and we are going to back the U.S. financial system, and we're going to fund the U.S. government, at least in theory, with low-yielding stable coins. And we will give you we're going to give you all these dollar-backed, treasury-backed U.S. stable coins, and it'll be fast and frictionless. And historically, stablecoin, again, these are going back to correlations, the growth in stable coins has correlated with the growth in Bitcoin. And if Besant's plan to increase stable coins issuance 10 times from today to something like 300 billion to 3 trillion or something, I think those numbers are directionally correct, then that would behoove a much larger market cap for Bitcoin. Again, China is basically saying, we have a different financial system. It's going to be backed by gold. And the U.S. seems to be saying, we have a different financial system. It's backed by technology, stable coins, and Bitcoin. And if that's the case, then both can go higher.
I have clients who own Bitcoin, and I haven't given up on the digital gold thesis yet either. I think that there's still plans that are being put in place, I think, to implement changes to the financial system that probably are very bullish for Bitcoin.
Yeah, that's why I used the word "yet" when I was talking about Bitcoin. It hasn't yet taken that real institutional global position as digital gold, but I think that it has that capacity, and I think that as what you're describing, Bill, that we may just be in the early stages of it. It's just gold has a much longer history of occupying that space.
I'll just sorry, this is going on a long time, and I'll at the risk of speaking too much. It was Zoltan Pozsar who used the term back in 2022, inside money and outside money. And I love that term. And I think going again to Adam's original question, why has gold elevated so much? And to some degree over lease time, why has Bitcoin elevated so much? historically, I would argue that both Bitcoin and gold were deemed as outside money. They were outside the banking systems. Inside money was primarily dollars and treasuries. That was the ultimate inside money. And that was the premier reserve asset. As the world is splintering, as we showed you with that 2022 correlation break after the Ukraine invasion, and gold is now replacing treasuries as the most owned asset by foreign banks, and as China is backing Yuan, by gold is all of a sudden becoming inside money. It's not outside the system anymore. It's not a threat. It's becoming inside. And I would argue, as the Trump administration has now regulated and lawfully embraced the crypto universe in Bitcoin, and as they are, planting their flag on the promise of stablecoins, they are making Bitcoin increasingly inside money. And as BlackRock, with the large Bitcoin ETF, the most successful ETF that it has, the most profitable ETF that BlackRock has is the IBIT, the Bitcoin ETF, which a lot of our clients own. As that becomes an institutionalized asset, instead of Bitcoin being, as it originally was, off in some other universe outside the system, the more important IBIT and Bitcoin becomes to BlackRock, which I would argue is another arm of the Federal Reserve, just like JP Morgan is, then the more the price of Bitcoin is embraced and needs to be supported. And that is a major signpost change, bringing Bitcoin in and gold in as inside money. Two other last things that I think are important. GLD, the main gold ETF, was historically always custodied by HSBC in London. And 2-ish years ago, JP Morgan decided to enter that business. And JP Morgan now is, I think, the major, at least second biggest, but I think now biggest custodian of GLD. Now, this is after JP Morgan and Jamie Dimon had said horrible things about gold, because gold then was outside money. And interestingly, somebody tapped Jamie Dimon, I believe, on the shoulder 2 years ago and said, "You're going to be custodian of this GLD." It wasn't because he all of a sudden changed, I don't think. It was because somebody in the government told him that gold was becoming inside money and that you better get on sides. And of course, all of a sudden they are on sides. Interestingly, Jamie Dimon, after years of calling Bitcoin rat poison, just 2 months ago basically said, we will use Bitcoin as collateral. It is now going to be collateral that you can lend against, which is, again, another signpost that Bitcoin is becoming inside money, institutionalized money, and therefore protected in a way. I think the path forward will be volatile, but higher.
Okay. That may be the last word, unless somebody has any last second thoughts that they want to share about gold that we haven't yet discussed. But anyways, great discussion. I think we covered a lot of ground, mostly related to gold, and look forward to talking about our next subject sometime in the coming months. Thanks so much.